Hey YouTube, it's Matthew Decker, Leverage Wealth Management. I hope that you're doing well today. I'm going to spend a little bit of time today going through one really simple concept, and that is the flexibility in how you take your income. Last week we talked about the different ways of using your 7-pay premium and how you can roll over unused funds, and we did that because we got a lot of questions about it. And this is a similar story. Get a lot of questions on the flexibility of your income payments, and so I want to go through that here in a little bit of detail. So we're going to start with the exact same example that we looked at last week, which is that $100,000 premium for 15 years. And what most people see when they look at policies like this is you're paying premiums for a set amount of time, 15 years, and then you see some kind of level income projection, 193,000 in this case, starting in year 16 and going for the rest of your life. So that's a pretty typical projection that we would see on an index universal life or a whole life insurance policy, really any form of cash value life insurance. You pay premiums for a set amount of years, then you slowly start taking that money out and you see some kind of level income projection. So a couple things about those level income projections. Number one, whenever you see this $193,000, you should immediately know that this is a projection, and really, you're not keying in on $193,000 a year. What you are really looking at is, this is a good placeholder value. This is a good guess as to kind of the median or the middle amount that you could expect. And what we like to tell people is you take that $193,000 and you go plus or minus 15% from that number. So 15% higher than 193 on the upside, if you get better than expected policy performance or market cooperation, and then 15% lower than 193 on the downside, worse than expected market performance, worse than expected market timing. And so really think of that 193 as a range, 15% on the high side, 15% on the low side. But this is how most people see those income projections. And I just want to show you that there's some flexibility in how you can actually take this income. So I've got two other examples that I want to run through rather quickly. So the first example that I want to look at is instead of using just a level income, $193,000 flat with no growth forever, I want to show you what it would look like if you actually adjusted for inflation, which you absolutely can do. And it doesn't actually require setting anything up on the front end. You simply request a lower amount to start and you inflate that every single year when you go to request your income. And so I want to show you what that would look like. So here we have our level income, and if we did go to something like an inflation adjusted income, it would look like this. So we start a little bit lower. We're starting at $132,000 a year instead of the 190, and we inflate that every single year by 3% or whatever number that you want to start with. And you can see that by age 74 here, we're back up to the 193, and that's going to continue to increase at 3% per year, so that you're not losing purchasing power. So are we starting with a lower figure? Yes, absolutely, we are starting with a lower figure, but you can kind of plan your expenses around a smaller number, knowing that since you're increasing it every year by 3% or 3.5% or 2.5%, whatever you want that number to be, you're not going to lose purchasing power along the way. And so it's easier to do retirement planning if you know that you're not going to lose purchasing power the longer into retirement that you go. And that can be a challenge if you just assume that levelized income from the start is, what do you do with inflation? You have to account for it with other funds. So that's the first thing that's absolutely doable. It doesn't require any kind of special policy mechanics or riders or anything on the front end. It's just something that you can do once you get into the income phase of your policy. So if you already have an index life insurance policy and you're like, oh man, I wish I would have included that inflation thing that Matt talked about on YouTube. Well, good news, it's on your policy. There's nothing that you have to add. It's just simply choosing to increase your income every year by inflation, assuming that you have the funds to do that inside the policy. So that's the first way that your income can kind of be molded to your needs. The other way that I want to show you here that's really interesting that a lot of people don't really talk about, and something that I think is probably the best use case, and these numbers are going to look a little bit weird because we're talking about $100,000 a year for 15 years, but What most people will end up doing or should do is only using their life insurance policy in those years where the market is down. And the reason that you would want to do that is because since this is a fixed indexed universal life insurance policy, fixed meaning it doesn't go backwards because of market losses, right? It's not, if the market's down 20%, this policy is not down 20%. And because of that, it makes it a really interesting vehicle for planning income when the market's down. So what this is showing you is, you get to retirement, you take out $190,000. It's within that plus or minus 15% range that we already talked about. But let's say that the market's just rip roaring for the next 4 years or so. And it's going really, really well. Well, you don't really need to dip into this account if the market is, just crushing it for you 4 years in a row. You can just take the gains out of your market-linked portfolio. But then let's say we have a big pullback 5 or 6 years into retirement, the market's down 20, 30, 40%. Well, now what we've done here is we've taken all that income that we could have taken from this policy in years 17, 18, 19, 20, and we rolled it all into one big distribution. So we're taking out $950,000 here in year 21. So it's kind of timing your income, turning it on and turning it off based on what the market's doing. And that is a great use case for index universal life insurance policies, because now you truly get the best of both worlds. And by the best of both worlds, what I mean is assuming you have some money at risk in the market, you're able to take advantage of maybe a higher risk portfolio in the market, knowing that this asset is safe. You can dip into this asset when the market's down 20, 30, 40%. You don't have to sell low and then rebuy high, which is the absolute worst thing that you can do. I take that back. The worst thing that you can do is actually to sell low because you need income. That's the worst thing that you can do. So in this scenario, you have this fixed asset that's not correlated to market losses. The market takes a nosedive. You're not panicking because you know that you're just going to double up or triple up out of your index universal life insurance policy. And in this case, we didn't take that $190,000 distribution for several years while the market was rip roaring. And then we basically pile it all into this year 21. And then we do the exact same thing these next 4 years, nothing out the next 4 years. And then let's say we have another market pullback and we take it all out in one big lump sum. There's so many different use cases for this type of strategy right here. Maybe you don't need almost $1 million in 1 year to live on. That would be pretty common, I would think. But what if you could use that nearly $1 million, pull it out of your life insurance policy when the market's down 20, 30, 40%, and you have dry powder that you can actually go in and instead of selling low, you can buy low. Now that's a really cool use case for an indexed universal life insurance policy. So in summary, I just want to kind of recap what we talked about. Whenever people are seeing, income projections, they're almost always seeing something like this, a flat income for life. And that's fine. It's a good job of just giving you an idea of what could be possible, but you need to know that it's really a range. We're talking plus or minus 15% on either side of this number is a really good ballpark figure for you to kind of wrap your head around. That's the first thing. The second thing is you don't have to take a level income. You could actually increase your income every single year by inflation. You didn't have to add anything special on the front end of that policy. You just have to request a little bit more every single year, assuming that you have the funds to be able to do that. And hopefully you're working with somebody that knows what they're doing and they can help coach you through that process. And then lastly, we talked about, using your life insurance policy as a source of dry powder for when the market has a pullback. You can suspend, withdrawing down on your assets in the market when the market is not performing the way that you want it to. And you can use your life insurance policy either as living expenses or as a place to kind of refuel or restock as dry powder to deploy money back into the market when it's experiencing a pullback. That is typically a good opportunity to buy low instead of what most people do is panic sell low. And now, you're really behind the 8 ball. So hopefully this has been helpful. As always, the goal of all of this is to give you information and education. I believe that the average person is smart and can understand these concepts. It just takes a little bit of time and working with somebody who knows what they're doing to really understand if these types of vehicles is going to be something that's going to be an overall benefit to your portfolio or not. So if you haven't already done so, subscribe to this channel. That way you can stay up to date and you can get notified when we put out more and more content, educational in nature. Click the bell so that you can be notified when that does happen. And then in the comments below, let me know what other things you want me to tackle on a weekly basis. Right now we're shooting on Thursdays, and so that'll be the cadence moving forward. So hopefully this has been helpful, and I look forward to talking with you soon. Take care.